It was the same morning, the same city. Two people walked through the doors of the same bank at almost the same time. Neither was carrying a large sum of cash. Neither had a lawyer in tow. They both came with a very simple task, to resolve a minor issue with their bank accounts. What happened next was strange. The first person went to the counter, spoke for a few minutes, and walked out with a smile. His request was approved immediately, but the second person had a completely different experience. He was told to wait. A few minutes passed, then more. After waiting for nearly 45 minutes, he received only one answer. "We're sorry. We are unable to help you at this moment." So, here's the question. The same bank, the same rules, the same type of request. Why was everything so easy for one person and so difficult for another? Some people will say it's about knowing the right people. Others will say it's just luck. But the reality is more surprising. The bank wasn't looking at their faces, their clothes, or even listening to their requests for the first time. The decision was made long before they even spoke. The difference wasn't in their appearance. It was in a number they themselves probably didn't think much of. And that very number determined whether the bank would see them as a customer or an opportunity. You might think the amount of money in their account was the key factor, but the interesting thing is, it's not that simple. To a bank, you are not just a balance. You are a financial profile that is constantly being evaluated. Think about it. If two people have the exact same amount in their accounts, will the bank treat them the same way? In most cases, the answer is no. Because a bank first wants to know how risky you are. Do you have a regular source of income? Do you pay back your loans on time? How stable are your financial habits? These are all critical signals for them. Then comes another factor, trust. The financial decisions you've made over the years are silently recorded by the bank's system, but it doesn't end there. The bank also seeks the answer to another question. How profitable is it for us to maintain a relationship with you? Because at the end of the day, banking is a business. They don't just look at today's transactions. They calculate the value you can create for them over the next 5 or 10 years. In other words, in the eyes of the bank, your identity is built on 4 pillars: risk, trust, behavior, and future potential. These 4 factors often open doors that most people never even know exist. But the most surprising part hasn't been revealed yet. Many people believe that a larger account balance will unlock every door in the bank. In reality, that's not always true. So at what exact moment does the bank's behavior really start to change? That is what we're going to find out next. There comes a time when the problem isn't just having less money in the account. The problem is that you've reached a state that can be called the financial danger zone. From the outside, it might not seem so terrifying, but in the bank's eyes, this is the most expensive place to be. Imagine you try to make a small payment. A few seconds later, a notification pops up on your phone. Transaction declined. You think it's just a temporary issue. But then another bill gets stuck. Then an automatic service fee is deducted. Oddly enough, the people who need money the most often end up paying the most in extra charges. A few days later, you might apply for a small credit card or personal loan. You're not asking for a huge amount, but within minutes, you get the answer, "Sorry, your application cannot be approved at this time." The reason is not always clearly stated, but the bank system has already made a decision about your financial profile. After that, the mental pressure begins. Every notification makes you wonder if another fee has been charged. Calling the bank means a long wait. Visiting a branch gets you the same answer. It's our policy. Slowly, you realize that the biggest problem isn't just a lack of money. The biggest problem is that the bank's trust in your financial situation has started to fade. But this is where a major misconception forms. Many people think they need to be a millionaire to escape this situation. In reality, that's not true. A small change can actually shift your position in the bank's eyes. The question is, what exactly is that change? We will find that out in the next part. The interesting thing is, it doesn't always take a large sum of money to change the bank's perspective. Often, they care less about how much money you have and more about how you are using it. For instance, let's say the amount of money coming into your account fluctuates each month, but one thing remains the same. You have regular transactions, you pay your bills on time, you don't unnecessarily go into overdraft, and your financial habits show consistency. From the outside, these seem like ordinary actions, but to the bank system, they are extremely valuable pieces of information. Because the bank doesn't just look at your current status, they look at your behavioral patterns. They want to know if you make responsible decisions under pressure. Are your financial habits stable, or do they change dramatically every month? This kind of data often becomes more important than the account balance in predicting a customer's future. This is precisely why two people with the same amount in their accounts can have different values in the bank's eyes. One person's financial behavior builds trust for the future, while the other's creates uncertainty. And the bank always prefers the customer whose future they can easily predict. This is where the invisible change begins. You might not notice anything, but the bank system is re-evaluating you, and the results of this evaluation will soon appear in front of you through offers that were never available to you before. This is where the bank stops testing you and starts observing you. But what happens when they become certain that you are a profitable customer in the long term? That's where the most interesting change begins. Then, one day, something happens that many people don't even notice at first. You didn't submit an application, you didn't make a request, yet one morning, a notification pops up on your phone. Congratulations, your credit limit has been increased. A few days later, another email arrives. This time it's an offer for a new credit card. Then maybe a personal loan offer at a lower interest rate than before. The question is, why is the same bank that saw you as a risk a few months ago suddenly knocking on your door? The change doesn't stop at offers. The service fees that used to be deducted regularly are now less frequent. When you contact them with a problem, the response comes much faster. In some cases, you even start dealing with the same representative because the bank now wants to build a long-term relationship with you. This is where most people get a common misconception. They think the bank has suddenly become generous, but in reality, the bank hasn't become generous. The bank has done the math. Their calculations show that retaining you is far more profitable than finding a new customer. So now they aren't just looking at your current balance. They are starting to invest in your future potential. This is the moment when you, for the first time, transform from being a cost to a valuable relationship for the bank. But there's another surprise here. You might think the bank now respects you. Actually, they are still just making a calculation, and that calculation can take you to a level where the standard rules for regular customers no longer apply to you in the same way. The question is, what lies beyond that invisible line? This change usually doesn't start with an email. The bank won't call you and say, "Congratulations, you are now a valued customer." Instead, everything happens so gradually that many people don't even realize their status has shifted. One day, you go to the bank and find you don't have to stand in a long queue. A complex issue is resolved much faster. When you call, you aren't constantly passed around to different people. Instead, a specific representative is aware of your previous issues. They are not just looking at your account number, they are starting to recognize you. Then you notice you are being informed about certain special banking services you've never heard of before. New types of accounts, enhanced benefits, priority support, even offers that aren't available to all customers. From the outside, these might seem like minor perks, but in the bank's language, it all means one thing. Maintaining a relationship with you is now more important to them than ever. But a misunderstanding can arise here. Many people think this is the bank's highest level of service. In reality, this is just an invisible upgrade. You are gradually entering the group where the bank sees you not just as an account holder, but as a long-term relationship. However, the real difference hasn't come yet. Because there is another level where the bank doesn't just provide faster service, they start making different decisions for you. The question is, who are the people for whom the bank reads the rulebook differently? But those for whom the bank truly changes the rules, they haven't even reached this level. A strange shift occurs when you reach a certain point. From here, the bank doesn't just look at your account balance to make decisions. Instead, they start to assess how valuable the relationship with you is. This is where the world of private banking begins. Now, you no longer have to call customer service for every problem. You have a dedicated banker who knows about your financial goals, your investment plans, and even your future decisions. You aren't looking for new opportunities. Often, the opportunities come to you. The most interesting part is that the nature of your conversation with the bank changes at this level. Before, you used to ask the bank for benefits. Now, in many cases, it's the bank asking, "What more can we do for you?" Because they have realized that maintaining a long-term relationship with you is a profitable investment for them, and this is where the true influence begins. You are no longer just a customer, you are someone the bank cannot afford to lose. Your decisions, your investments, Even which bank you choose to stay with, these matters become important to them, because the competition now isn't just for money, it's for relationships. But believe me, even this isn't the end. Because there are people for whom the bank doesn't just provide special services, they change the interpretation of the rules if needed. At that point, it's no longer just banking, it becomes a game of influence. And that's where the game is no longer just about money. A time comes when the bank no longer sees you as just a wealthy customer. Instead, they realize that losing you isn't just about losing an account, it's about losing a long-term business relationship. At this stage, many things are no longer like they are for everyone else. New investment opportunities come to you first. When discussing large loans, the terms are often structured around your situation. Before any major decision is made, the bank's representatives contact you directly, sometimes over the phone, sometimes in a personal meeting. Here, you are not just a number, you are a client who is worth the bank's time. The most surprising thing is that at this stage, many rules are not strictly applied. The goal is singular, to ensure you don't move to another bank. So, to maintain the relationship, they don't hesitate to offer customized solutions, special privileges, and personal service. But this raises a question. Is the bank really showing you more respect? Or are they just trying to keep a client who will generate more income for them in the future? And this is where ordinary people make the biggest mistake. They think it's about respect. In reality, it's not about respect. It's a business decision. And it's time to break this illusion. Many people believe that banks respect rich people more. This idea has been presented to us for years, but the reality is a bit different. The bank is not impressed by your car, your house, or your lifestyle. They look at only one thing. How profitable is it for them to have a relationship with you? If you can create more value for the bank over the next 10 years, then you are important. If you can't, then even your current wealth won't always buy you special privileges. This is the biggest truth about banking. Banks don't protect the rich, they protect their own profits. And the sooner you understand this truth, the sooner you'll realize that the bank's real decisions are never made with emotion, but always with calculation. Now go back to the very beginning of the video. The same bank, the same day, the same type of request. Yet one person finished their work in a few minutes and left, while the other waited a long time and didn't receive the desired answer. Today, you know the difference wasn't in their identity, their clothes, or even just the amount in their account. The difference was that, in the eyes of the bank, one was a cost, and the other was a source of future revenue. Banks never judge people. Banks judge which person can create the most value for them in the future. And that's why, even when walking through the same door, the bank's doors do not open equally for everyone.